So we have been through a wild ride last year with COVID, right? So from the declaration of pandemic, record number of jobs lost, eviction moratoriums, and then literally trillions of dollars of stimulus. Like you read headlines, rents are down, right? The housing foreclosure crisis is coming. But where does that really leave us? What are we seeing, as we're managing 2,000 portfolios and we're conversations with other apartment building owners like us? What are we actually seeing, and what's in our crystal ball? And that's what we're going to talk about next. To help us unpack this topic is Drew Niffen, president of Nighthawk Equity. Hey, Drew, how's it going?
Hey, Michael, good. How are you?
All right, so I want to know from you, I want to get a status update. And, we were always watching these headlines and it's going on, and we're kind of biting our nails a little bit. We're not exactly sure what's real and what's not. Is this still a good time to buy? Should we wait? What do you think, Drew? Give us an update.
Well, Michael, there is so much going on in this topic, and we could spend hours talking about it together, but we won't. We'll try to keep it pretty concise. But in all my years of watching and being a part of the apartment building investing industry, this past 12 months has by far been the busiest, most wild ride we've ever had. And yet, despite all of that, it's true that it's been wild. The reality is that amongst this unprecedented pandemic, there is really not that much has changed. So for instance, let's zoom out from a pandemic and small data points and think about this. Apartment building continues to be, in my mind, a great place to invest. We still have the same leverage, tax benefits. We operate in a recession-resistant, essential industry that no one can displace, that no one has invented yet something that can replace having a roof over your head. And we continue to see the government's tremendous willingness to support this industry, both for landlords and for tenants, because it's essential to our economy. And so at a macro level, despite all that has happened, it still is where I want to be placing my money.
Yeah, that's exactly right. But nevertheless, we hear repeatedly over the last year that the cities are being vacated. People are moving out of the cities. COVID is pushing down rents. Vacancies are up. What has been our experience across our portfolio?
Our experience has been different than the headlines, Michael. So it's true. The headlines are true. There has been a huge reversal in fortunes for some landlords in the country. They were seeing at one point in time, it was all roses. They were seeing meteoric rises in rents, 10% year over year. And we have seen those numbers reverse in retreat over the pandemic. That is true. It has been a very hard 14, 15 months for some landlords in certain geographies, in certain asset classes. We've seen this mostly on the gateway cities, Michael. So cities like New York, where rents have dropped 18% in the last year. San Francisco, 25% drop in the last year, according to some reports. Silicon Valley, 17%. And Seattle, where I live, 15%. Those are huge decreases. But what's true in those gateway cities is not true for the whole nation. We invest largely in the Southeast and the Sun Belt cities. And in fact, those places have generally seen an increase. We've seen that COVID and the remote work phenomenon has demonstrated the fungibility of locations. So people that used to sit in a studio in Silicon Valley paying $2,500 a month, all of a sudden are thinking, man, I can go to Colorado Springs and get a 3-bedroom house for the same price and still log in over Zoom to work. And we've seen people doing that. I've seen it anecdotally in my life amongst family and friends, and we've seen it in the data. We've seen people moving. And so the headline here is, no one buys the national market. People buy an apartment building in a geography, and you have to look at the local market, not the national market, to really make sense of the data and how it impacts you.
Well, that's exactly right. But there's so much data, right? And how do you make sense of it all? Is it one of those things where there might be an analysis paralysis, or how do you make sense of it all, and how do you use it to guide your decisions?
First off, as I said in the beginning, you have to take the data in context. It's been an incredible year with a tremendous amount of turbulence. You remember the week about a year ago where unemployment went in a single week from 3% to 13%. And it was like the sky was falling. Everything was over. But again, go back to the data that I was just saying a minute ago. And in the markets that we're in, it's been the reversal of the big coastal cities. So Memphis has had 11.8% increase in rents in the last year. Tampa, another Sunbelt city, 8% up in the last year. Detroit, 6% up. Atlanta, where we're putting a lot of our investment capital right now, up almost 6% again last year. And that's in a tier one city. So you have to look at the data and think not only about the COVID headlines, but also the local markets. And again, go back to the fundamentals that I was saying. Those fundamentals have not changed. People still need housing. Demographic trends before COVID and accelerated during COVID have people moving to more sort of tier two cities and cities that are in the Southeast. And lastly, it continues to be true that bankers underwrite loans, home loans, with scrutiny. And so a lot of Americans can't get a mortgage. Their only housing option is apartment buildings. And we serve that tremendous function. That's not going to change. And so for that reason, this is going to continue to be a good place for us to put our money.
Yeah, I mean, that's a good point. And, we saw when COVID first came out, you can always gauge the riskiness of investment by the kind of loans you get from lenders. And so when COVID first came out, first of all, the entire bridge lending industry went away overnight. Boom, gone. No more bridge loans, just disappeared. And then government-backed loans started getting more conservative, and they wanted escrows, 9 to 12 months of escrows. And so you could tell that, oh my gosh, the banks weren't quite sure where it's going to go. They're still putting out loans, but they're getting a little more cautious. They're adding a little layer of security. But now, over the last 6 months or so, that has now disappeared, and we're back to kind of where it was before COVID. So you kind of get a sense where the financial institutions are gauging the risk on that. Now, what I'm hearing you say is that the fundamentals are still there. However, regionally, the outlook may differ. And so while the national headlines on an average perspective might say there's no rent growth or even negative rent growth, that really what it means is that there's negative rent growth in some areas and positive in the other. Can't we maybe avoid those areas like New York or San Francisco or some of the larger cities? And can we maybe go to some of those areas that are experiencing some of those growths like you just talked about, like Atlanta or Huntsville, even Memphis, for goodness sakes, who's not been growing at all,
Yeah. Yeah, and of course we can make that choice. We choose every day when we talk to our mentoring students about what geography do you want to be in, why, what is the background for that, and so obviously we choose the areas where there's a tailwind of growth. And I don't want to be too. Just one more thing, Michael. I don't want to be too Pollyannish about this, as if everything is wonderful. We have made some changes to be careful and conservative in our underwriting. So once COVID hit, every single deal that we modeled, we zeroed out growth to 0% for the first year. That's even though the markets that we are investing in, as you and I were just saying, those markets are growing. I mean, 11% in Memphis, which is crazy, 6% in Atlanta. So those are growing markets, but we've zeroed out growth in the first year just to be conservative. And we are doing things like as you just said, we're baking in extra reserves that the lenders are requiring, which requires us to raise more money. So we are underwriting things differently. So we are adjusting to the COVID reality, but we're also mindful of the big picture, those big demographic trends, those big, narratives that are decades long. And those are the long-term macroeconomic trends that are really going to drive our investments over the years.
Yeah, so we continue to like the asset class. We're watching it. I mean, we've had conversations around getting into other asset classes, and we might do that at the point where we think that this won't work anymore, but we still think it's fundamentally sound for the reasons you mentioned. We are making tactical changes, underwriting changes. We've changed some of the way that we manage our properties, and we're cautious. We're cautious, but we're still taking action. We actually closed a deal recently. We have getting one under contract right now. So if we'd love to talk to you about these investments. If you're interested in investing in these syndications, we'd love to have a conversation with you. Our investment company is called Nighthawk Equity at nighthawkequity.com. Head over there, click the join button. You can join our investor club, fill out a short form, and then we'll have a conversation with you. And if you think the investment is right for you, we can share with you some of our upcoming opportunities. So check that out. Hey, Drew, I want to thank you for coming on here and giving us an update and looking into your crystal ball.
You are welcome, Michael. Glad to be here. Thanks so much.